Okay.
Gauge Howard. Would you mind if I pop by your office this
You
afternoon?
come by.
Sorry?
Come by. Yeah.
Maybe 1:30 or...
1:30 sounds good.
Okay,
Okay.
thanks so much.
Okay, folks. It's too late for reminders, but I'm going to remind you again that this is the last week of class. Which is good news and bad news, right? The bad news is it is the last week of class, which means you have a lot of stuff to do. The good news is it is the last week of class and you're done. So next Monday is when your project is due by 5 p.m. It doesn't have to be turned in before class, by 5 p.m. on Monday. So try not to do a lot of your project on Monday. It's not a good idea. So if you're done on Friday, Saturday, Sunday, go ahead and send it to me anyway. So you don't have to wait till Monday. I will send you a summary sheet on Wednesday where I'm going to ask you for numbers on your companies. And the reason I would like that is on Monday, actually, all I'm going to do is take your companies and show you what you found in terms of dividend policy, capital structure, valuation, everything you did, so you can see the distribution of Jensen's alphas and EVAs and whatever else you do. So we'll, but wait on Wednesday, I'll send, it's a little Excel spreadsheet, just numbers that you've got, so when you get a chance, if you can fill it in and send it in to me, that'll be great. Also, the final exam for this class, official final exam, is a week from Friday, which is Friday the 13th. Now, if you feel really superstitious about Friday the 13th, or you're unable to take the exam on Friday the 13th, there is an early exam option that I sent you, but some of you might have lost that link already. But there's a Google shared spreadsheet. We got to go sign up because there's only a certain capacity I have. So I'll send that link out again because I think there are still a few slots available. So if you need to do it on the 11th, just make sure you put your name down there. Right? Any questions? Okay, so let's pick up where we left off. We were talking about dividend policy, and I was talking about how dysfunctional dividends are at companies. How they get stuck paying dividends because that's what they've always done. And dividends also evoke strange responses from governments and politicians. So I'll give you at least a couple of things I've seen politicians and governments suggest, and you tell me what you think the consequences of this would be, or whether you think it's a good idea. So let's assume you see companies accumulating cash. For instance, US companies are accumulating huge amounts of cash. Okay? $2 billion in trapped cash, $3.5, $4, $5 billion in overall cash. Let's say somebody looks at it and says, this is a bad idea. This cash really should go to stockholders. And they mandate that every company pay out at least 40% of its earnings in dividends. You think that's a good idea? Or let me rephrase it. If that law passes that every company has to pay 40% of its earnings as dividends, or 35, or pick some number, I want you to tell me which group of the companies I'm going to list out are going to be the companies that are going to be hurt the most from this action. Is it going to be large companies making huge profits? Probably not, because they're probably mature companies that can afford to pay out 40%. What about small companies losing money? They're losing money, so 40% of losses is still losses. No. How about high growth companies that are losing money? Again, losing money. But can you see why with high growth companies that are making money, this could be deadly? Because what's the characteristic of high growth companies that are making money? They're making money, but their free cash flow to equity is probably going to be a big negative number. Now, what am I asking them to do? Pay 40% of their net income as dividends. It's going to kill those companies. Terrible idea, right? You know who's going to be lobbying the strongest for this idea? Large companies making big profits. There's always a vested interest. When you see something that doesn't make sense, kind of established in practice, it doesn't get there by accident. And once it gets there, there are a whole group of companies and a whole group of lobbyists who will push to keep it there because somebody is being helped by this. So when you hear people talk about we should mandate that 30-40% of earnings be paid out as dividends, remember who you're going to end up hurting. You're going to end up hurting the smallest, highest growth companies, and essentially you're going to mean the largest companies that dominate the market are going to continue to dominate even more. There's also talk in the US, it's strange how people can talk about the same phenomenon from two sides of the picture, about how US companies are not reinvesting enough. It's a big story now in the Wall Street Journal, you see it in the New York Times, it's a political story, it's an economic story. And much of that ire is directed not at dividends but at stock buybacks, right? Because that's supposedly the reason companies are not reinvesting money. So let's suppose I throw another populist scheme on the table. I say, look, this is terrible that companies are not investing money. Every company should reinvest at least 60% of its income back into the business. Good idea, bad idea? What are the consequences of that? You're going to get a lot more reinvestment, right? You're saying this is good, lots of factories will be built by companies that are in bad businesses, and about the truth eventually wins out. If your cost structure is so high you can't compete and your factory is closed, and I force you to open a factory, that factory is not going to become economically efficient in 5 or 6 years. So what you're going to do is throw a lot of money down the tube, and then 5 years later the factory is going to close anyway. Bottom line, I don't think government should have anything to do with dividend policy. You think who's going to change it? The responsibility ultimately has to come on the people who get the dividends. If stockholders feel that those dividends will be better directed into reinvestment, they should be the ones who say it's okay. No? And similarly, if stockholders feel that you're reinvesting too much in bad projects, it is their prerogative to say, look, that's my cash, I want that cash back. So if you read stories about, I think in the French the presidential election like 6 years ago, the second policy of every company being required to reinvest was actually promoted by one of the party candidates saying, this is what we need to do, is to actually force companies to reinvest because that's the only way you can keep growth going in the economy. So now let me move to a third case study. Remember the role you were playing? You were playing the role of shareholders in a company, and we went through Apple and Vale. Here's my third company. It's British Petroleum in 92. You're saying, why the heck are you going back to British Petroleum in 92? I think this might be the most dysfunctional dividend policy I've ever seen in my life. And it actually happened by accident that I latched onto it, because in 91 and 92, I was asked to do a very strange project by British Petroleum. They asked me to fly to London. They flew in 12 of their brightest petroleum engineers into a room, and they said, teach them all the corporate finance they need to know in 2 days. And you know what? 2 days was more than enough. These guys were bright, they were numbers oriented, they got it. They said, this is all there is, this is what the CFO does, and said, that's it. He hides behind all kinds of words, but this is what he's doing. But in the process of doing that, I actually decided to use British Petroleum as my example, because what's the point of talking about Disney to a group of petroleum engineers? So I went through the cost of capital, everything that you've done in your project. I get to the dividend section, I compute the free cash flow to equity, and I come up with $571 million. Remind me again, how much dividend can a company with $571 million free cash flow to equity pay out? About $571 million, roughly speaking, right? Over this 10-year period between 83 and 92, British Petroleum paid out $1.5 billion every year. That's about $1 billion more than they have available in free cash flow equity. And every year they went to the bank and borrowed that extra $1 billion to make up the difference. And by 92, they were a basket case. They were the most highly levered oil company in the world, and everybody knew they had a dividend problem, including the janitor. You know how he knew? Because he wanted a new broom, and they said, not this year. We need every pound we have to pay dividends. So between 83 and 92, this is a problem that was festering for an entire decade. And the big question is, why didn't somebody do something about it? This isn't an invisible problem. Everybody knows about it. Why didn't they do something in 86 and 87 and 88? I'll take you to the top management meeting in 1987. You can see very quickly why nothing gets done. So the top management BP, they're sitting around a table. Now, Oxbridge accent is awful, but I'll try. So, we have a problem, old boy. Aye. Everybody agrees. No? This is the old days. British Petroleum Lord so-and-so, Viscount so-and-so. Everybody agrees there's a dividend problem. We've got to do something about dividends, old boy. Aye. Everybody agrees. Fine, right? Something going to get done, but nothing gets done. And to understand why, I'm going to tell you a fairy tale. This is one of my favorite fairy tales when I was a kid. It's about these mice that live in an abandoned house. And there's a cat that lives in the same house, and obviously the mice are not very happy about the cat. It's kind of reducing the population of the mice. So the mice call a meeting. I've never been at a mice meeting, but it's probably pretty chaotic. Lots of mice gathered around. And the mice said, we have to do something about the cat. Aye. All the other mice agree. And one of the mice comes up with this absolutely brilliant idea. He says, let's put a bell on the cat. Brilliant, right? Because then you know when the cat's around, you can go hide. Aye, everybody agrees again. Great idea. Until one of the more practical mice asks the key question, which is, who's going to put the bell on the cat? And the answer is, not me. Maybe you. No. Same thing applies in the BP. Everybody agrees you have a dividend problem. You've got to cut dividends until one of the more practical people at the table says, who's going to tell the stockholders? You're saying, what's wrong with telling the stockholders? You can't afford to pay the dividends. Remember what I said last session? You get the stockholders you deserve. You pay small dividends, you get stockholders who like small dividends. You pay big dividends, you get stockholders who like big dividends. You pay obscenely big dividends, you get dividend addicts. We talked about what happens when you get in front of a group of dividend addicts and say, look, I'm going to cut your dividends. I don't care how reasonable your argument is, it's not going to fly. So nobody wants to do it. Not me. I'm going to have laryngitis. Meeting 6 months. I'll plan to have laryngitis. I won't be there. Then there's always this person at every meeting who says, let's wait, maybe something good will happen. Which for an oil company is what? Maybe oil prices will go up. There was a brief period in 1991 when Saddam Hussein wandered into Kuwait, when oil prices spiked for a couple of weeks. You could see people at BP dancing on their desks. No more dividend prom. But then a few weeks later, oil prices were back down again. The dividend prom was back. 92, finally BP cuts dividends. Somebody had the courage to do the right thing. You know why they had to cut dividends? Where did they get the $1 billion every year? They went to the bank and borrowed the money. And when 92, when they tried to do that, the bank said, no, you're done. You're already the most levered oil company. We can't lend you the money. They were forced to cut dividends by externals. It's the worst way to cut dividends because you've lost control of the process. And to show you that the market is not going to treat you kindly, this is the headline that showed up when BP cut dividends. BP shares plummet after dividends are cut. He's saying, but you did the right thing. How come the market's not reacting positively? To finish the story, if you followed through, about 3 months later, the stock price had fully recovered. But during that 3-month period, guess what was happening? All these people who had gathered in your room, those dividend addicts, are leaving the company. A new group of stockholders coming in. But that doesn't happen instantaneously. And in that 3-month period, half of BP's top managers lost their jobs. You know what? They deserve to. They deserve to because they let a problem continue for a decade until it got out of their control. It's never easy to cut dividends. So I'm not going to claim that dividend cuts are going to be, markets are going to say, oh, this is wonderful. In fact, this is from a study that looked at companies that cut dividends for different reasons. And for every group of companies, so some companies cut their dividends because they had an earnings drop, so they were doing badly. Some companies cut their dividends because they had good investment opportunities in the future. They cut so one is a bad reason, one is a good reason. On the day that they announce a dividend cut, guess what? The market treats them all badly. But if you track through the companies that actually did it for the right reasons, the price does come back. Markets can behave irrationally, but they won't stay irrationally low or high based on a dividend announcement. That requires some faith. But that's what you often need to do if you're a manager of a company with a dysfunctional dividend policies. You got to make the decision when you control, when you can spin the action, and you got to package it with what you plan to do with the cash. Otherwise, people are going to assume the worst about you. Your stock price is going to drop and stay down. Because what else can I read into your story that you cut dividends? Okay? Any questions? Yes?
Regarding the mandated dividend payouts, has every sector other than the REIT sector or the real estate industry seen that type of?
It's mostly self-mandated. So there's no other sector in the US that's required to pay out dividends other than MLPs and REITs. Okay? So if banks pay dividends, it's not because somebody from the outside says you have to pay dividends. It's self-imposed. So every other sector in the US, you're free to set your dividend policy. Okay? We'll talk about, in my next example, we'll talk about other things that they talk about when they say this is why we don't want to cut dividends. But no, companies are free to set their own dividends. Right? Any other questions? Fourth example. So this was the limited between 83 and 92. The limited between 83 and 92 with the Gap was one of the fastest growing retail stores in the US. Every week you open a new limited store. And this was actually their free cash flow equity over that 10-year period. And over that 10-year period, the free cash flow equity of the limited was minus 34 million. Again, let me ask a basic question. How much dividend can a company with negative free cash flow equity afford to pay out? Zero. They managed to pay out about $41 million in dividends. And they're not alone. I've seen high growth companies with negative free cash flows equity, and some of you might be working with these companies that continue to pay dividends. I don't know what gets them started, but I'll try. I'll give you a sales pitch that probably gets a young high growth company started paying dividends. You ready? You're the limited. It's the mid-80s. You're not paying dividends, and I come to you with a pitch. I'm your investment banker, consultant, whatever. I come and tell you that if you don't pay dividends like you are right now, there are investors who can't buy your shares. Is that true? Yeah, there are pension funds, for instance, that by mandate are required to stay only invested in stocks that pay dividends. I know you can't pay dividends, but I suggest you pay a little dividend, just a small dividend. That way, you see what my pitch is? If you pay a small dividend, you can get on the list of these investors who otherwise couldn't buy it. It's demand supply, right? You have more investors, same number of shares, your share price will go up. Sounds incredibly alluring, just a little bit. What's the problem with that pitch? What did I describe people like dividends as? Addicts. Try this with an addict. Say, have a little cocaine, please, but just stop. Just a little bit. You invite a dividend addict into your investor base, you offer them a little dividend, what are they going to want next? It's natural, that's what they go after. If you can't afford to pay dividends, don't go looking for trouble. You don't want pension funds owning your stock because they're going to put pressure on you to pay dividends even if you can't afford it. It's not because they're bad investors, but it's because that's what they need as cash flows. There are enough investors out there who are okay with you not paying dividends. Just go after them. But this is how I think trouble gets started, is people say, just pay a little dividend. What's going to happen? I mean, the limited started with $1 million in dividends. They ended up with $101 million 5 years later. That's what a little dividends does to you, is those investors come and they pressure you to pay more in dividends. Final example. I took Tata Motors. Remember, part of a family group of companies? I computed the free cash flow equity. Pre-debt, it was about minus 106 million. Right? But remember, they borrowed all that money using Tata Consulting Services. So post-debt, they had about 825. But if you use what they could afford, they were still paying well above their free cash flow equity as dividends. Their dividends and buybacks were about 75 billion rupees. They could have paid about 47 billion rupees. Clearly, they're paying more than they can. Here, though, I'm not sure what to read of this because it's part of a family group. So again, you have this subsidy effect, right, where you have one company holding back on dividends, another company paying out more in dividends, one company not borrowing money, the other company borrowing tons of money. I don't know whose interests are being served here, but if I'm a stockholder in Tata Motors, they borrow too much, they pay too much in dividends, they're a mess as a standalone company. But I'm loath to say they should change because they're part of this big group which is not going to let them change. This is again part of the problem with you being an investor in a family group company is much of what they do will make no sense as a standalone company because they're serving a bigger interest. So if any of you are working with family group companies, don't be surprised to see strange looking capital structures, strange looking dividend policies because they're being driven by forces from outside the company. So here's how I took my 5 companies and I put them into the matrix. Remember I said there's a useful way to look at companies? And for me, 4 of my 5 companies actually were paying out more than they could afford to. Their dividends and buybacks exceeded. 3 of those 5 had good projects at the time that I looked at them. Vale might have made a transition into bad projects now, but at the time that I looked at them, Disney, Vale, and Tata Motors. Deutsche had both a cash deficit and bad projects, so it's in significant trouble. And the only company that had the flexibility to do what they needed to do was Baidu. They paid no dividends, but there was no pressure to return cash, partly because the corporate governance is weak and partly because they delivered good results as a company. So when you think about dividend policy, step back. Don't get too caught up in the numbers. It's about trust. Ask yourself, do I trust this company? And please don't email me and say, should I trust this company? You know your company better than I do at this point in time, or you should. Because you work with it for, I was going to say 12, 13 weeks, but at least a week or 2. You've been getting intimate with your company. Make your own judgment. I'm okay with your judgment. It's a judgment. Your judgment is as good as mine based on the information you have. Just base it on something you've seen on the ground that will lead you to trust the company. Any questions on dividends? So that's the dividend part of the project, is looking at what your company could have afforded to. The spreadsheet, as I said, goes up to 10 years. You don't have to go 10 if you want to go just 5. Compute the free cash flow equity, compute the dividends, compare what the company paid to what it could have paid. Then look at its projects, look at its Jensen's Alpha. You might not even need to do it in the dividend spreadsheet because you might have already done it in other parts of the project. Bring it all together and say, based on what I know about this company, I'm okay with its dividend policy because I trust the managers, or I'm not okay. In either direction, they're paying too much, they're paying too little. And give them a suggestion on how they should go about changing the dividend policy. Okay? Now, the other way in which you can look at dividends is to do the same thing we did in capital structure, where we looked at other companies in the sector and said, if they're all paying dividends, I'm going to pay dividends too. So in that context, here's what I did. I took my companies and I took the dividend yield and payout ratio for my companies. And then I compared it to my peer group. And I defined the peer group differently for each company. For Disney, I defined it as US entertainment companies. So you look at dividend yield and payout ratio for Disney, it's very close to what the sector is paying. Disney's dividend yield is 1.17%. The dividend yield for the sector is 0.96%. Their payout ratio is 17.11%. Or if you take 2013, it's 21.58%. The dividend payout ratio for the sector is, if I didn't know better, I would say that's how they set dividends, is looking at the average. But that average is a little deceptive. If you look at the next page, I actually took the entire sector and I computed the yield and payout ratio for each one. And the reason I did this is even though the average numbers look very close, look at the median payout ratio and the median dividend yield for a US entertainment company. The typical US entertainment company pays no dividends because it's too small and too risky. One of the problems with these peer group comparisons, you're looking at averages. Averages can hide a lot of noise. I think it's a terrible way to set dividends, but having said that, it's the way most companies seem to think about dividends. What's everybody else paying using an average or a median? What should we be doing? We're okay. So you can look at the other comparisons as well. And again, I'm not sure what to do with these comparisons other than look at the sector, look at the company and say, hey, you look okay relative to the sector, but the entire sector might be a basket case. Yeah. And in fact, if you look at financial service companies, you notice the high payout ratios and the high yields are not just Deutsche Bank specific, they cut across the entire sector. So dividends are, I think, of all aspects of corporate finance, you get the most qualitative analysis to kick in because you can look at the numbers, but ultimately you got a judgment to make. Right? In fact, after last week's Apple announcement, expect a lot more pressure on Apple to give cash back. It's the nature. We talked about deposits and withdrawals. Apple made a big withdrawal last week from its account. And not surprising, you're going to see pressure build up. My guess is Apple will preempt that pressure and probably do a significant buyback at today's prices. But no, what do I know? Finally, to expand this peer group comparison, I ran a market regression. Remember how I did this with the debt ratio? I looked at what drove differences in debt ratios across companies. I took a dividend payout ratios and dividend yields for US companies. But before you get too excited about either of these regressions, notice the R-squareds are pretty low, 20% and 26%. There's a lot of dividend policy I cannot explain based on fundamentals. And the fundamentals I used were the beta to capture the risk of the company. My argument is higher risk companies should pay out less in dividends. Higher growth companies should pay out less in dividends. And companies with higher debt ratios can afford to pay out more in dividends because there's more cash available. The signs are all in the right direction, but that's neither here nor there. So the regressions you can use to plug in the numbers for any company to come up with what the yield and payout ratio should be for that company, given how the rest of the world is setting ratios. If you want the updated 2016 debt and dividend yield regressions, they're on my website. I'll send the link to you. Again, if you want to plug in the numbers for your company, do so, but I don't think you're going to get much other than a kind of a noisy estimate. And I plugged in the numbers for Disney into those regressions. I got a predicted payout ratio of 27% if they behave just like the rest of the market, and a predicted yield of about 1.4%. They're paying slightly less than what I'd expect them to. Their actual payout ratio was 21.58%, and their actual dividend yield was about 1.09%. So at least based on the regression, the argument is they're paying less in dividends. They can afford to pay a little more. But again, I'm focusing just on dividends. I'm not bringing in buybacks. And once I bring in buybacks, the whole equation starts to blow up on you because Disney did return a lot of cash, but it did it in the form of buybacks rather than dividends. Okay. So we're in the last stretch here. As you probably well know, the other class I teach is a valuation class. And I think of these two classes as kind of bookends to each other. The way I describe the difference between the two classes is corporate finance, you look at companies from the inside out. Valuation, you look at those same companies from the outside in. And you know what? If you get corporate finance, you actually have all the pieces you need for valuation. You've actually done the basics of the valuation class. So what I want to do is at least give you a flavor of how all of this connects to value. Because after all, the objective of the firm is supposed to be to maximize value, right? So we've kind of talked around this all through this class, but we've never actually valued a company. So I'm going to start off with that very first quote you see on the previous page. It's from Oscar Wilde, where he described a cynic as somebody who knows the price of everything and the value of nothing. And you know what? You can replace the word cynic with trader and mean exactly the same thing. Okay? And I don't mean that as an insult. It really is what goes on in much of what gets called valuation is really pricing. And there's nothing wrong with it. You're pricing things rather than valuing them. But I want to focus on the valuation side of this for this class. In the valuation class, we'll talk about what if your job is pricing something? How would you do things differently? So there are three ways in which you can approach putting a number on an asset. The first is what I'm going to call intrinsic valuation. Sounds really fancy, but once you start stripping the basics, you're going to see you've been doing intrinsic valuation all the way through this class. When you did the Netflix case, you were doing an intrinsic valuation. When we did the Disney theme park, we were doing an intrinsic valuation, but I think it's not a valuation, it's a capital budgeting project. And the capital budgeting project is just a mini valuation. It keeps things under control. Much of what we've said so far in the context of capital budgeting becomes part of valuation. So in intrinsic valuation, you value an asset based on its fundamentals, its cash flows, its growth, its risk. Sounds like a strange thing to do, right? You think, what else would you look at? In relative valuation, you're really pricing an asset. The analogy I offer is, when you go to buy a house or an apartment, how the realtor puts a number on that house or apartment, right? Think about it. How does the realtor attach a number to your house? What does he or she do? Looks at other houses, transactions that have happened in the last few months, and says, you have an extra bedroom, a bigger backyard, therefore your house is worth $550,000. He or she is pricing your house. I've never seen a realtor sit down and do a discounted cash flow valuation of the house and say, you know what, your house is worth $533,355.44. I used 8% cost of capital. It doesn't work, right? It's pricing. At least realtors are honest about what they're doing. They say it's pricing. Don't confuse me with what's the value of the house. I don't know. I don't care. You want to buy this house, you got to pay the price. Relative valuation is that very simple concept extended to businesses. But you can see how much more messy it becomes when you want to price a company rather than price a house, right? To price a company, what do I need to find? I need to find other companies just like it. Think about it for a moment. If to price Microsoft, what do I need? I need 6 other companies just like Microsoft. Good luck to you on that. So already you're stretching the definition of comparable. And then you can't compare prices across companies. Why not? I was in Omaha last Friday at the Chosen Ones meetings. And I just gave a talk on Friday and I left. I might have been the only person who flew into Omaha on Thursday night and flew out on Friday afternoon. But what's Berkshire Hathaway's stock price right now? $220,000 or something, right? So basically it'll be entire wealth to buy one share. You see why you can't compare prices? A penny stock will look really cheap to you because it's only a penny, and Berkshire Hathaway will look expensive. Prices are not comparable because they're a function of an arbitrary decision you made of how many shares you have as a company. The more shares, if I have a 2-for-1 stock split, my stock doesn't get 50% cheaper, my price will drop by 50%. So what does this mean in the context of pricing? Because you can't compare the prices across companies, you divide the price by something. Price by earnings, price by book value, enterprise value by EBITDA. A multiple is just a standardized price. If you worked in real estate, it actually happens even in real estate. When you have properties with different sizes, they'll have a price per square foot. So basically, you standardize the price, you compare across companies that are really not comparable, and then you tell me a story. That's relative valuation. You come to that first fork in the road. You have to decide, am I pricing something or valuing something? In this session, I'm going to focus on the valuation branch. And there's one add-on I can put in, which is perhaps the only thing in valuation that's new and different, that's developed over the last 4 years. There are some businesses that are better valued as options. I talked a little bit about this in the context of capital budgeting. You have a young biotechnology company with a patent, no revenues, no earnings, no cash flows. A patent working its way through the FDA pipeline. You're not buying a set of cash flows. You're not pricing it because there's nothing to price. You're buying an option. An option in what sense? If it makes it through the approval process, you could have a blockbuster drug, but if it doesn't, there's nothing. That's the essence of an option. All valuations that you see out there, you can put into one of these 3 buckets. And it's critical that you classify it up front, because otherwise you're going to be asking the wrong questions. So let's focus on intrinsic valuation. When I do my valuation sometimes online and people want to insult me, they accuse me of being either an academic, which I don't take personally. I mean, the way they say academic, it's not meant as a compliment. Right? So don't, or as a theorist, which makes me laugh. See, you're a valuation theorist. You know how long my valuation session lasts? Less long than it used to, because we keep cutting sessions off every semester and charging you the same price. Right? But it's 26 sessions. Just like this class. You know how much theory there is in the class? That's it. It's one equation. That's the entire class theory. The value of an asset is the present value of the expected cash flows on that asset. And that was actually the very foundations. Wasn't that the very first class? That's it. That's my theory. Everything in my valuation class is about estimation details. How do I get cash flows? How do I come up with discount rates? So let me back up here. You have an equation that drives value. But when I look at that equation, I'm thinking about questions to which I need answers to value a company. So start thinking about your company or any company you're interested in, because these are the 4 questions I would ask you to come up with a value for your company. The first question I'm going to ask you is, what are your cash flows from existing assets? Remember I broke your balance sheet down into existing assets and growth assets? What are your cash flows from existing assets? So for this, you're going to pull out your 10K, your annual report. So I'm going to take your financials because it's going to give me some information about your cash flows from existing assets. That's the easiest part of valuation. Because that's what all you can do is look at the past. You can come up with numbers based on the past. But that's just the first question. The second question I'm going to ask you is, what is the value you're going to create from future growth? Notice how I phrased that question. I'm going to ask you, what's your future growth going to be? Why? Growth has a good side, right? The good side of growth is it makes your earnings grow faster. Growth has a bad side, which is, how do you get growth? You've got to put money back into the business. There's reinvestment. So it has a good side. It makes your earnings grow faster. It has a bad side. It makes you have to put cash back into the business. Could the net effect of growth be negative? In fact, remember that graph I showed you of what percentage of companies earn less than their cost of capital? 55% of companies globally destroy value while they grow. So when I ask you what's your value of growth, I'm open to three possible answers. The first, and this is the answer I'd like to hear, is I can create value from growth because I earn more than my cost of capital, and you give me a good basis for that. The second is I'm just running in place. What does that mean? You're growing, but you're growing and earning your cost of capital. Your growth is going to not create a cent in value, even though you become a bigger firm. You're saying that's awful, but there's a third answer you could give me that's worse, right? You're growing, and you're actually earning well below your cost of capital. You grow, but you destroy value as you grow. So when you talk about value of growth, not only do you have to estimate how much growth there is in the company, you also have to look at how much the company is investing to get that growth, because the net effect is what's going to drive the value of growth. So what are your cash flows from existing assets? What's the value of growth? Third question I'm going to ask you is, how risky are these cash flows? You're saying, why don't you just ask, what's a beta of the equity? Don't mistake tools for end games. The reason I want to separate the two is, even at the end of this class, after I've forced you to lever and unlever betas and compute a cost of capital based on betas, you should be skeptical about whether this beta thing actually works. Because I am. I might not have revealed that. I don't know. It could be completely wrong. What if tomorrow I wake up to a revelation that beta is a horrible way to measure risk and I shouldn't be using it? I'm not going to throw out a discounted cash flow valuation architecture just because I don't like the way I measure risk. I'm going to come up with a different way of measuring risk. In fact, in the valuation class, I'll give you 11 alternatives to betas and let you pick whichever one you want. Because I'm okay with you coming up with a different way of measuring risk, because ultimately the one thing we can't debate is that risk matters. Risk affects value, and if you have a riskier business, you should be paying a lower value. So that shows up in the discount rate. And then I'm going to ask you a final question. When will the good times end? So what are you talking about? When you're valuing a publicly traded company, unlike a finite project, at least in theory, this company can keep going and going and going forever. So all I need to do to value this company is do what? Estimate cash flows forever. That's my vision of hell. First I show up in hell, I'm pretty pissed off I'm there. I see the devil walking towards me, he's dressed up like an investment banker, don't ask me why. He says, welcome to hell. I don't want to be there, but I see I have no choice. So, okay, what do you want me to do? He says, I'd like you to do some valuations. I say, okay, that's not too bad. I did it all through my regular life, but I guess I could keep doing it. Then he points me towards a computer to get started, and it's a Dell. Already my vision of hell is taking form. I'm a Mac user. You point me towards a Dell, I don't even know where to start. It's one of those blue-colored Dells or red. Remember when they tried to be stylish and they changed the color of the back? He says, okay, Dell, I guess it's Excel. I can get around and learn enough to deal with it. So who am I valuing? GE. It's like Groundhog Day. Value GE over and over again. For how long? You're going to estimate cash flows forever. This is a spreadsheet that never ends. 2017, 2018, 2019, 2020, 2,655. I'm still estimating cash flows. And you see why in the real world you constantly ask the question, can I stop now? How about right now? Because estimating cash flows each year, I'm pulling you further and further into that dark zone where you say, I don't know what's going to happen in 2021. I don't even know whether there's going to be a word in 2021. Why you ask me these questions? So you need closure in valuations. You can't estimate cash flows forever. And the way we get closure is we assume that at some point in time in the future, our cash flows will start growing at a constant rate forever. I told you everything you need in valuation we've already dealt with already, right? I mean, remember in the context of project, we talked about growing perpetuities. That's our device for closure, but it extracts a cost. To use that closure, I have to assume you grow at a constant rate forever, right? How high can that rate be? Or what can it not be? It cannot be higher than the growth rate of the economy. Why not? Mathematically, it's impossible. You're saying, what if I have global growth? You can't be larger than the global economy, so use the global growth rate. And I suggest a very simple proxy that works for me. It might not work for you, which is whatever you've used as your risk-free rate, I said is a good way to think about what your nominal growth in GDP will be over time. You're saying, but that's so low. Hey, well, remember, it being low helped you in your cost of capital. So here I'm saying it helped you. Now I'm going to hold the other string back and say you can't use a 6% growth rate in perpetuity and a 1.8% risk-free rate. There's something internally inconsistent about what you're doing. So when I ask you, when will the good times end? I'm asking you, when will your company become a mature company? You know one answer I'm not willing to accept? Never. And you know how often you'll get that answer? Ask somebody, when will Facebook be a mature company? Your answer right now will be, oh, it'll never be a mature company. It's such an amazing company. Mark Zuckerberg is such a wonderful manager. You know how often I've heard that? I heard that with IBM in 1981. IBM was one of the great growth companies of history. It grew at well above the growth rate of the economy for almost 50 years. One of the great growth experiments of all time. In 1981, people said, IBM will never be a mature company. Look, it's been growing for so long. And of course, by the late 80s, IBM wished it were a mature company because its growth rate was negative. Then you get to the late 80s, early 90s, Microsoft will never be a mature company. It's such a great company. Walmart will never be a mature company. It's such a great company. Guess what? Every company eventually will become a mature company. Why? Because the more successful you are, the larger you grow. The larger you grow, the more difficult it becomes for you to keep growing. My distinction between great companies and just good companies is great companies are able to fight aging for a longer period. They're able to push off. And once in a while they reinvent themselves and find a way to get back to growth. And those become our legendary CEOs, right? Jack Welch at GE. Because when he came into GE, it was the ultimate boring mature company. Whether by hook or by crook, maybe more crook than hook. He made it a growth company for about 15 years. Then of course there's a Steve Jobs coming into Apple in the late 90s. But when will your company become a mature company is really a question I need to ask, because that's when I stop estimating cash flows, use this perpetual growth model to capture what happens after that. That becomes, of course, the tail that wags every valuation dog, the terminal value. So let's set the table. I have a business, I call you in to value my business. There are two ways you can approach valuation. And actually, as I say this, think back to capital budgeting, because we went through the same process in capital budgeting. The first way you can value my business is to focus just on me as the equity investor and value my equity. So let's play a game. Let's suppose this is a business. You guys are equity investors. You guys are the lenders to the business, right? I raised equity from you. I raised bank loans from you. I started the business. If I'm valuing just the equity in the business, here's what I'm going to focus on. I'm going to focus on the cash flows you get as equity investors from the business, which is cash flows left over after you paid those guys, right? After debt payments. We've already measured something like that. That was actually the free cash flow equity, right? The cash flows left over after debt payments. Or if you don't like free cash flow equity and you want to stick with dividends, that's fine as well. You're focused on cash flows you get as equity investors. If that is the cash flow I'm looking at, then the discount rate I should be applying is the rate of return you demand as equity investors for investing in my stock. If that sounds familiar, that's of course your cost of equity. The same cost of equity we used in corporate finance now becomes the discount rate I use to discount cash flows to equity back to today. I get a value for equity. So that's the first way to do valuation, is be equity focused, care only about equity investors, do the valuation, you'll end up with the value of the equity in the business. Sounds promising, right? It does work most of the time, unless equity becomes a rump of the company. Most of the company is dead, then you're focusing on a very small slice of the company. So here's the second alternative. Rather than focus on just valuing equity, I could try to value the entire business. You're saying, what does that even mean? Remember that for this business, I got capital from equity investors and capital from you. They get free cash flows equity, whatever's left over. What do you guys get as cash flows? As lenders, what are your cash flows from the business? Interest payments and principal payments. What you collectively get out of this business, kind of counterintuitive. Think of the lenders as partners. What you collectively get out of the business is called the cash flow to the firm. And if that is the cash flow I'm discounting, think about the discount rate I should be using. It should no longer be the cost of equity. It should be a weighted average of what the equity investors want, the cost of equity, and what the lenders want, which is the cost of debt, which of course is the cost of capital. Cash flows the business, discounted back at the cost of capital, gives you the value of the entire business. Now, if I still want to value equity, how do I get from the value of the business to value of equity? What do I need to subtract out? I just need to subtract out what I owe you guys. I subtract out the debt. I've got a value for equity. You've got to make up your mind when you sit down to value business, whether you're focusing on equity or focusing on the firm. Because the way you get the inputs will be different depending on which one you decide to focus on. So let's start with cash flows, right? So you sit down to value business, you're saying, what do I discount? Should I discount cash flow of the firm or cash flow to equity? And within cash flow to equity, should I be discounting dividends or free cash flow to equity? So generically, you have three different types of cash flows you can discount. You're trying to decide which one should you do. When you cannot estimate cash flows, you're kind of stuck. You have to discount dividends. You say, when would I not be able to estimate cash flows? What do I need to estimate cash flows? CapEx, depreciation, working capital, right? Remember when we started talking about banks and financial service firms, one of the things we struggled with is, how the hell am I going to estimate CapEx for a bank or working capital for a bank? Until 2008, if you look at every one of my valuation books, I get to the chapter on valuing banks, and I throw up my hands. I say, look, I'd love to estimate cash flows for a bank. I have no idea what they are. Therefore, I'm just going to discount dividends. That remained the last bastion for the dividend discount model, but I was driven there by desperation, not by desire. Desperation because I could not estimate cash flows. But when I use dividends, I'm making two big assumptions. The first is that banks are run by sensible people. And the second is that they pay out what they can afford to pay out in dividends, right? Because it's trust. And both of those beliefs got shaken badly in 2008. I'm no longer willing to believe that banks are run by sensible people. And I'm no longer willing to believe that what they pay out is what they can afford to pay out. So that's why you saw the architecture I created for Deutsche Bank, where I tried to estimate a free cash flow to equity based on defining reinvestment not as CapEx and working capital, but as investment in regulatory capital. So even with banks and investment banks now, I'm increasingly moving away from dividends. But if you really get desperate and say, look, I can't estimate cash flows, dividends are your choice. I hope not to see any dividend discount models in this class, because none of you should be that desperate in coming up with cash flows, because you've already done the work to get to dividends and free cash flow to equity. If your company's debt ratio is stable, you say, how would I know? Judgment call. What would you base it on? If your company's debt ratio has been around 30% for the last 20 years, my guess is it's pretty stable. If it goes from 3 to 55 to 12, it's not stable. This is common sense. So I can't tell you this is a stable company, this is not. That's your call to make. If your company has a stable debt ratio, then I think you're going to be okay using free cash flow to equity. Why? Because you can use the shortcut. Remember the shortcut we went through with the stable debt ratio? Net income minus net capex times 1 minus the debt ratio. So essentially, so if your debt ratio is stable, you can use a free cash flow to equity. You're saying, what if I'm not sure? Then go to the third approach. Estimate the cash flow to the firm, value the entire business. So basically, it's almost like you come to forks in the road. Can I estimate cash flows? No, go to the dividend discount model. Yes, you're going to come to a choice, a free cash flow to equity or free cash flow to the firm. Ask yourself, do I feel comfortable assuming that the debt ratio for this firm will stay at where it is today? If the answer is no, go with the free cash flow to the firm. If the answer is yes, you can go with free cash flow to equity. So what I'm going to do is go through the ingredients that drive valuation, at least lay the foundations. And as we go through, you're going to see pages that look familiar because I've just cut and pasted from a previous page, because much of what we've done before is going to revisit us now in the context of valuation. To value a business, I need cash flows, I need growth, I need a discount rate, and I need closure. So here's what we're going to do. You guys are going to do an equity valuation. You guys are going to value a business. And with each input, you're going to see how the inputs are going to be different. Let's start with cash flows. As equity investors, when I ask you what your cash flows are always going to be after debt payments or free cash flow to equity. And if you don't like to use free cash flow to equity, dividends. But when I ask you that question, remember your cash flows are to everybody. They'll be pre-debt cash flows. Again, I don't want to be mysterious. Remember how we computed cash flow for Disney after tax operating income minus net cap, plus depreciation, minus capex, minus change in working capital, and we stop there. No interest payments, no debt payments. That's a cash flow to the firm. So the definition of cash flow is going to be very different. And the numbers are going to be very different. You see why? If you have a lot of debt, your cash flow to equity could be negative. Your cash flow to the firm can be a big positive number. Second, I'm going to ask you what your growth rate is. And I ask you that question as equity investors, you're focused on growth in equity numbers, net income, earnings per share. But when I ask you that question, because you're valuing the entire firm, the growth rate you should be talking about is growth in operating income, growth in revenues, because you're looking at the entire business. You say, what's the difference? If you think about a healthy company's balance sheet, here's what it'll look like. Your revenues grow at 3%. Your operating income will grow at 5%. Why? Because you have fixed costs. Your net income will grow at 8%. Why? Because you have interest expenses. And your earnings per share could actually grow at 10%. Why? Because you're buying back shares. If you're valuing a business and you use that 10% growth in earnings per share as your growth in operating income, I guarantee you're going to overvalue the company because you've used the wrong judgment on the growth rate. So cash flows are going to be different. Growth is going to be different. Then I ask you, what discount rate do you plan to apply on the cash flows? And if you're the equity investors, the discount rate you're going to give me is a cost of equity. Whereas when I ask you that question, you're going to say, well, I get capital from both debt and equity. You're going to give me the cost of capital. The closure question, when you stop, the cash flows will be the same for both equity and the firm. Because if you tell me your firm is a mature firm, it's got to be mature in every dimension. So in terms of closure, all that will be different is you'll be estimating the value of equity 10 years out. That will be a terminal value, but you'll be estimating the value of the entire business. It's just basically what you focus on will drive how you estimate the numbers. So I'm going to start with cash flows. And then we're going to go on to discount rates. And then we'll move to growth. And then we're going to end with the elephant in the room, terminal value, because it's a number that scares people the most when they do valuation. But I'm going to suggest some very simple rules to keep it under control. So let's start with cash flows. Okay? Cash flow can either be cash flow to equity or cash flow to the firm. Cash flow to the firm is after-tax operating income plus depreciation minus capex minus change in working capital. That's how you estimated cash flows for Netflix, Disney. So that's a cash flow, a pre-debt cash flow, but it's after taxes and after reinvestment. If it's cash flow to equity, there are three ways I can define it. The first is I can trust in dividends and say that's the only cash flow I see, so I'm going to focus on it. But you already saw that graph for US companies, right? For every dollar that they pay out in dividends, they're paying out almost $2 in buybacks. So a second version of the model is to say I'm going to add buybacks onto dividends, and I'm going to say that's my cash flow. It's not just dividends, it's dividends plus buybacks. But in either case, you're trusting what companies do as a measure of what they can afford to pay out. If you don't trust what companies do as a measure of what they can pay out, that's when the free cash flow to equity comes in. That is your potential dividend. So with equity cash flows, you can either focus on actual dividends, augmented dividends, or potential dividends. Different choices will probably give you different values, but again, you have to be comfortable with doing any of those. So let's start with dividends. I actually have two valuations of Deutsche in the book. One was a 2008 valuation, when I call my days of innocence, when I valued banks as if they were run by sensible people and what they paid as dividends were in fact what they could afford to pay out. So I'm going to show you a dividend discount model. And my 2008 valuation, I did value Deutsche based entirely on dividends. Then you're going to see a valuation in 2013 where I've lost all faith in banks being run by sensible people. And so I don't trust the dividends. I'm going to estimate free cash flow equity, and I'm going to use the free cash flow equity I showed you in, I think, last session or 2 sessions ago, where I took the net income and I subtracted out the reinvestment they have to make in regulatory capital to come up with the free cash flow equity. And you can already see why I shouldn't be trusting Deutsche. They're paying dividends, but their free cash flow equity is a big negative number. When I value the equity, I've got to bring in that expectation that they will have to issue new equity. That's what a negative free cash flow equity is, to get the regulatory capital fixed. So with Deutsche, you're going to see both the dividend discount model, old-fashioned, as well as a kind of updated free cash flow equity model. For Tata Motors, I estimated free cash flow equity. I'm going to do a free cash flow equity valuation because Tata Motors' debt ratio has been pretty stable over time. They've had that 39% debt that you saw, or 30% debt, pretty much for the last decade or so. So here's how I'm going to estimate the free cash flow equity. I'm going to start with the net income, which has some negative years in 2008, 2009. I'm going to subtract out capex. I'm going to add depreciation. I'm going to subtract the change in working capital. The change in debt becomes a cash inflow when it's a positive number and a cash outflow when it's a negative number. I'm going to come up with how much they're reinvesting back in the business and their free cash flow equity each year. In the last column, I actually have computed what's called an equity reinvestment rate. The way to read that is during this 5-year period, for every $1 in net income that Tata Motors brought in, 88 cents of that equity income went back into the business, into net capex, change in working capital, even after covering for debt. So they were reinvesting a lot. Some of that came from the Jaguar Land Rover acquisition because that was part of the reinvestment. But this is giving me at least a sense of how much money Tata Motors made in terms of equity income and how much is actually left over. The answer is not much because you're reinvesting a substantial amount. And for free cash flow to the firm, for Disney, I kind of stepped back and said, look, I'm focusing on the entire business. The operating income, adjusted for leases. By now you kind of remember what that adjustment is? When I capitalize leases, I make a debt. When I make a debt, my operating income has to get restated because I no longer am treating lease expenses as expenses. So that's the operating income. That's now going to drive my valuation. My effective tax rate is 31%. We pause right there. When we did cost of debt, what is the rule that we kept as an ironclad rule? To compute the cost of debt, you always use which tax rate? The marginal tax rate. And the argument was? It's not fair because I was the one who made the argument and I'm asking you what my argument was. Maybe I've forgotten. What's the rationale for using marginal tax rate? It's at the margin. Interest saves you taxes on your last dollar of income, not the middle, not the first. Now I'm asking for a tax rate for an entirely different reason. I'm trying to compute your cash flows after taxes as a business. Now you can see why I might want to use an effective tax rate here, because this is the tax rate I'm paying not on the last dollar, but on the entire $10 billion. Now, will I be able to keep the tax rate at 31% forever? That's questionable because I might be deferring taxes, they catch up with me. But at least for the near term, I'm okay with the 31% tax rate. 2 sets of rules. With the cost of debt, it's always marginal. But when it comes to computing cash flows, the entire business, I'm okay with you using an effective tax rate, at least for the near term, because you can defer taxes on your overall income. So that's my 31% tax rate. The capex, including acquisitions, is $5.24 billion. He's saying, why including acquisitions? There are 2 ways you can grow, right? One is you can take projects yourself and pay for them. The other is you can buy other people's projects, which is what an acquisition is. Why should I have 2 sets of rules? It's okay, you can grow through acquisitions. I'm not stopping you. I'm going to give you the benefit of the growth, but the price you pay will be what you pay for acquisitions. That's the $5.239 billion. The depreciation and amortization for the year was $2,192 million, and their working capital increased by $103 million. So let me pull all those numbers together. I took the $10,032 million operating income, net of taxes, using the effective tax rate, $6.92 billion. I subtracted from that my net capex. Capex minus depreciation. Again, I want to kind of emphasize, net capex, I'm just netting the 2 out simply because it reduces my line items, and I think it actually makes sense to net the 2 out because one pays for a lot of the other. The change in working capital is 103. My free cash flow to Disney as a company is about $3.188 billion. That is before debt payments. And I want it to be before debt payments because I'm valuing the entire business. In fact, I'm going to compute a ratio that I'm going to use later, and you're going to see why. See that after-tax operating income is $6.92 billion. Their free cash flow to the firm was about $3.13 billion. So obviously, what did they do? They reinvested about $3.7 or $3.8 billion, right? I'm going to take that reinvestment of $3.7 billion, divided by the 6,920 million, and I'm going to come up with what I call a reinvestment rate of 54%. What is it telling me? For every $100 in after-tax operating income that Disney made in 2013, $53.93 went back into the business. Is it good or bad that they put back 54%? It depends. Depends on what? On what they put it in, right? So I haven't given you the other half of the equation, but I've said they've reinvested a lot, but don't get too excited. Because they could be one of those 55% of companies. When I say they reinvested a lot, you say, oh my God, I wish they hadn't. So I have to show you the other half of the picture, but this is going to become a big part of how I think about future growth. Yes?
So here we're adjusting the operating income to include the leases.
It's a little more messy than that, right? When I adjust for operating income, I add back the lease expense, but I also have to subtract out the depreciation on the leased asset. So it actually could be a very small adjustment if the depreciation offsets the expense. So it's only if your lease expenses are climbing over time that this will actually make your operating income go up. So it's not just adding back the lease expense, it's adding the lease expense and subtracting other depreciation. Exactly.
But I have a question there because, I understand we did this to compute the WACC.
Right.
But in this case, we're changing the cash flows. And so, for example, in the interest expense, you also must adjust it for the lease.
Right. But remember, when I'm doing free cash flow to the firm, what I do below the line.
For the equity.
Yeah, for the equity. But the equity, see, I'll tell you, with the equity, you don't even have to worry. Here's what's going to happen. All that happens in equity is my lease expense is going to get replaced by two expenses, an interest expense and a depreciation expense. And the two expenses will be the same, mathematically. So my net income will never change if I capitalize leases. And the reason is simple. All I've done is move lease expense from an operating to a financial expense, but it's still an expense. So when I'm doing an equity-based valuation, converting leases has no effect on my net income and free cash flow to equity. It's only when I value the entire business that it's going to have an effect on my cash flows, an effect on my cost of capital, an effect on my value as a business, but then I'm going to be subtracting out a debt number that includes leases as debt. So internally, everything is going to be different as a business when I capitalize leases, but only in the firm valuation, not in the equity valuation. That's one of the nice things about equity valuation is leases don't even matter. They just fly in and out now because they really are moving things above the line. Net income is after all expenses, financial and operating. So just the fact that you moved an operating expense to a financial expense has zero effect on value.
And but when you show the numbers, you're going to see like an expanded.
You'll have a higher operating income, but you'll have the same net income. Right? So you basically what will happen is your operating income will increase, your interest expense will also increase by exactly the same amount. So when I have the higher operating income minus the higher interest expense, I'm going to end up with the same net income. So it will make your financial statements look different, and it should. Because if you're a retailer, you're actually borrowing a ton of money. So your operating income is a lie, so I'm fixing that lie, but your net income is okay because it's after all expenses. So it's really at the business level that you start to see the problem. And the reason you want to see it at the business level is I need to know whether you're a company with there's a big difference between a company with $10 million in debt and $90 million value, and $110 million in debt and $200 million in value. The value of equity you get might be the same, but the composition matters to me because I need to know how much you've borrowed. So that's what it's going to do. It's going to change all your numbers, but the ultimate equity value. No. Well, it's a question. You're writing a check out, right? So all I'm doing is you're still paying that money. You're paying what you call it as a $1,000 lease expense. All I'm doing is saying is that it's just like when you write a mortgage payment. You don't write a mortgage payment partly to interest and partly to principal. You write a mortgage payment to the bank that's the same amount every month, right? And then I go in and say, of that mortgage payment, 150 was interest, 850 was principal. That's exactly what I'm doing here. I'm just taking the payment you're making and saying, hey, you know what? That was not all interest expense or lease expense. Some of it was interest, some of it was principal repaid, and I'm breaking it out for you. But I'm making it off the payments you're making as a company. So that's my cash flow. Let's talk about the discount rate I should be applying on this. And I'm going to re-emphasize a point when I made with capital budgeting. And again, I want to make sure that this point gets through. The biggest issue in discounted cash flow valuation is maintaining consistency. In what sense? You tell me how you estimate your cash flows, and I'll tell you what discount rate you should be using on those cash flows. So today I talked about if your cash flows are after debt payments, your discount rate has to be a cost of equity. If they're before debt payments, they've got to be a cost of capital. Let me extend on that concept. If your cash flows are in dollars, your discount rate has to be in dollars. Your cash flows are in reals, your discount rate has to be in reals. If your cash flows are real, your discount rate has to be real. So when you do your cash flows, you're already laying the foundations for how you think about discount rates. And guess what? This is one of those cases where you've done your corporate financial analysis and come up with the cost of equity and cost of capital for the company. I'm just now looking at the same company from the other side. And the same cost of equity and the same cost of capital will now become discount rates I use to value the equity and the capital in this firm. So I'll take you back to Deutsche. In early 2008, when I did my dividend discount model valuation of Deutsche, I needed a cost of equity. I started with the risk, and I did all my dividends in euros, so my cost of equity had to be in euros. I started with the euro risk-free rate, which in January 2008 was 4%. I used a beta based on a bottom-up beta for Deutsche then, of 1.16, and I used an equity risk premium of 4.5% because that's what it looked like in early 2008, a much less risky world. Cost of equity you're going to see for Deutsche in my dividend discount model in 2008 was 9.23%. So file that away. That was almost 8 years ago. In November 2013, when I revisited my valuation of Deutsche, I'm still focused on equity cash flows, but now I'm using free cash flow equity. I started with the risk-free rate of 1.75% because that's what the euro risk-free rate had dropped to then. You're saying this is going to bring down my cost of equity? It didn't bring it down very much, and here's why. My beta stayed about the same, but look at what happened to my risk premium. That's the hidden story of what I think has happened over the last 8 years. It's not that the cost of equity of companies have collapsed because the risk premiums have gone up. The composition has changed. Less of it comes from the risk-free rate, more of it comes from the risk premium. Think of what that number will look like today. What's the risk-free rate in euros? Somebody must be doing a euro valuation. What's the risk-free rate right now? What's it? For euros, it's a German, it should be about the German 10-year bond rate, right? I think it's less than 1%. It's like 0.6, 0.7%. Hopefully you don't have to redo your entire project now, so I think you're okay. It's about 0.6 or 0.7%. It's one of those currencies that's trying to drive towards zero. So your risk-free rate is now really, really low. But the risk premium is actually expended even more. So you can see how you have to keep your eyes on both numbers. So that's your cost of equity. It's exactly the same cost of equity. Everything we said about the cost of equity in the context of corporate finance has to be said here as well. So that becomes your discount rate if you're looking at the dividends of free cash flow equity for Deutsche. For Tata Motors, this page actually cut and pasted from 200 pages ago, from packet 1. I did a bottom-up beta based upon the fact that they were an automobile company. I came up with a levered beta that reflected debt to equity ratio. And the risk premium that I used was the weighted average equity risk premium based on the parts of the world they operate in. Risk-free rate in rupees. I know it's been too long, I'll remind you again. I got that by taking the Indian government bond rate of 8.82% and subtracting out the quiz 1, right? Distant memory. 8.82 minus, that's the 6.57%. The beta is a bottom-up beta. The equity risk premium is a weighted average of where they do business. So it's exactly the same process. Cost of equity you're going to see in my Tata Motors equity valuation is 13.5%. Let's do Disney's cost of capital. And again, this is a slide I've shown you 4 different times in different contexts. It's the existing cost of capital for Disney. And to get the cost of capital, I started with the US dollar risk-free rate because I'm doing everything in US dollars, 2.75% in November of 2013. Bottom-up beta, 1.0013. I don't want to show you that page, but that's breaking Disney down into 5 businesses, now working through the process. Equity risk premium 5.76% because Disney is 82% US, 18% outside. Cost of equity of about 8.52%. The cost of debt for Disney, I started with the rating for Disney. I did a synthetic rating, but I'm not going to let hubris let me use a synthetic rating. I'm going to go with the actual rating. Cost of debt of 3.75%. That's with the default spread of 1% over the risk-free rate. There I used the marginal tax rate. So it might seem inconsistent that I have an effective tax rate driving my cash flows and a marginal tax rate driving my cost of debt, but I'm measuring 2 different things here. I end up with a cost of debt after tax of 2.4%. There's our existing market value weights. 88.6% equity, 11.4% debt, 7.81%. Somebody asked me the question though. When we did capital structure, what did I conclude for Disney? Come on. Did I say it conclude it was under levered or over levered? Under levered. In fact, I came up with an optimal debt ratio of 40%. So ask me why when I'm doing valuation, I'm not using the optimal. Why am I not using the optimal? In fact, I see analysts doing this all the time, using target debt ratios. It scares the heck out of me. You know why I'm not using it? Because I'm not Bob Iger. I don't run the company. I can think whatever I want about the optimal, but the reality is I have to... Remember what I talked about investing? You're looking at the company from the outside in. So you could look at Valiant, you could look at Volkswagen, you could look at any company and say, if I ran the company, I would do things differently. But guess what? You don't run the company. When you value the company, you got to take what's given to you. And in this case, what I have right now is their existing debt ratio. I'll come back and play with it and ask questions about it. But for my initial valuation, I'm going to compute the cost of capital based on that existing debt ratio. Cost of capital I get is 7.81%. That's exactly the cost of capital I've used all the way through until I got to capital structure. Yes? You're just one slide ahead of me, right? And in valuation, that's particularly critical, and here's why. This is my cost of capital to start the game, right? But what am I doing? I'm projecting out next year, 2 years out. And as I'm projecting out what's happening in my company, my growth is changing, my revenues are changing, my margins are changing. I have never understood why people get fixated on one cost of capital all the way through. It's less of an issue with Disney than if I value Twitter. You can see why with a company like Twitter, it's extraordinarily dangerous to get stuck with one cost of capital because the cost of capital you're computing for your company today is not consistent with what you're telling me about the company 5 years out or 10 years out, where it's a larger, more mature, profitable company. In the case of Disney, the degree of change is relatively small because they're already pretty close to mature. But here's what I did. As I went through time, I allowed for the fact that both my cost of equity and my cost of debt would change. In this case, since their beta is pretty close to 1 already, I didn't have much change to make. But let's say you're valuing a company with a beta of 1.8. Right now, your cost of capital is going to reflect that beta, right? And that's fine. But when you value the company and you make this company a mature company 5 years or 10 years out, don't leave the beta at 1.8. The beta should change over time towards what you think a mature company should have. It's internally inconsistent to make your company mature in terms of growth and leave it with the cost of capital of a high growth, high risk company. So what you're seeing in my last column is my cost of capital changing, partly because my beta is changing, very little. My cost of debt remains the same because a single A rating is pretty much what a mature company is. I could make it a AAA rating, but ExxonMobil just lost their AAA rating. There are 6 companies left in the world with AAA ratings. Okay? I did push their debt ratio up because they are trying, you can see this, but they're changing very much. I don't think they're going to get to 40. But I think they will move up to 20. You're saying, how do you know? I don't know a thing. This is my estimate for what will happen. This is my valuation of Disney. When you value Disney, you can make very different judgments. Valuations are personal. You have a story to tell about a company. The numbers are your way of telling that story. So don't feel shy about putting out a story. And if people say you're wrong, ask them, how do you know? So you got a story, I've got a story. This is my story. You don't like my story. Do your own. That's my reaction when people don't like my assumptions and valuation is you have to make your best judgments. So I'm not going to, this is also good news for you. On your valuation, I'm not going to contest you on your judgments. Just don't do anything stupid with your valuation if you've made a really bad judgment. So you got to make that decision yourself. So don't come up with this huge number for your company because you think it can grow at 80% a year for the next 10 years when it can really grow at 8, and then go out and buy. So don't put real money behind this until you feel a little more confident. But tell your story about the company. That's what this cost of capital is reflecting. So especially with high growth companies, this is what I do. Incidentally, the spreadsheet that I've sent you, the FCFF simple Ginzu spreadsheet, is actually a spreadsheet designed to protect you from your worst instincts. So in a sense, I do this for you. So when you enter the cost of capital, I actually move this to the cost of capital of a mature company. But then towards the end of the spreadsheet, I ask you questions which essentially will let you hang yourself. So this is what I'm doing. Do you want me to change it? And if you say yes, I'll let you do whatever you want. So basically so look at those last 5 default questions, because the defaults are what I've used to kind of keep the valuation kind of going and staying consistent internally. So you've got cash flows, we've got a cost of capital. Let's at least lay the foundations for growth. How many of you have worked in valuation as bankers or anybody here? Don't worry, I won't ask you really tough questions. I'll just set you up. And nobody? Come on. Somebody must have. You've worked in valuation. So when you value a company, you usually need a growth rate, right? Where did you get your growth rates? Okay, so you were valuing just mature businesses? Okay, that made your life easy. So let's move. So there you can just say growth rate of the economy is 2%, 3%. Yeah. But if you have to value, let's say you have to value Facebook for an IPO, clearly that's not going to work. So then if I asked you where you get your growth rates, what's the answer? What are the possible sources for your growth rates? It'll be very difficult to back out a growth rate from multiples. That's pricing, but if you want a growth rate in earnings or revenues, I mean, think about it. What's the first thing we look at? When you look at your company, say, what will the growth rate be for the future? You look at the past, right? You say, what did they grow at last 3 years? So you look at historical growth. What else? You ask the managers, stupid biased source you can think of, what do you think the growth of the company will be? You ask your managing director, what do you think I should use as a growth rate? Why? Because if it goes wrong, then you can blame the guy. In other words, in most valuations, growth is an exogenous input. It comes from outside. It just lands in your spreadsheet. Next thing you know, it takes over your spreadsheet. And that's a very dangerous place in valuation to be if that growth rate is a number that you just made up. And here's why. You use that made up growth rate, you come up with a value, and the value is too low. You say, what do you mean too low? Let's face it, most of the time when you sit down to value a company, you already have a number in your head, right? You want to get there. You get too low, what do? After all, you made up the growth rate. You try 12, you try 14, you try 16 until you get to a value you wanted. This is an exercise in kabuki valuation. It looks like you've done a valuation, but there's really nothing about a valuation that you've done. If you want to claim ownership of the value of a company, growth has to be your input. And it's got to be tied to what the company does. It's not in my power or your power to go around endowing companies with high growth just because you feel like it. Companies have to earn high growth, and here's the way to think about growth. You've got to pull off a really tough trick to be a high quality, high growth company. You've got to be able to reinvest a lot. You have to have a high reinvestment rate. I think that's easy. You're right, that by itself is easy. But at the same time, you have to maintain a high return on that reinvestment. That's the tough part. Is most companies can pull off one half of the equation. They can reinvest a lot and not reinvest very well. Or they reinvest very little and they reinvest at a high return. To be able to reinvest a lot and reinvest well is one of the toughest things to pull off in business. Those are our great growth businesses. Apple during the last decade, Google right now. These are companies that have found an incredibly efficient way to grow with high reinvestment and high return on capital going together. In fact, I'm going to mathematically tie the two at some point in time. For the next 3 or 4 years, if you want your margins to drive your growth, I'm going to let that happen. But once you get to some kind of steady state, I'm going to say your growth rate is going to be the product of those two numbers. And which two numbers I use will depend on whether you're focused on equity or whether you're focused on the entire business. If you're focused on equity, I'm going to define what you reinvest as a percentage of the net income you put back into the business. So when you think about the dividend payout ratio of 20%, remember that tells you the retention ratio is 1 minus the payout ratio. 80% gets back into the business. And how well you reinvest, I'm going to measure with your return on equity. Again, a number we did in a different context, but that number drives your growth in equity income. When you're looking at growth in operating income, I'm going to look at the reinvestment rate, which I did for Disney, net capex and change in working capital as a percentage of your after-tax operating income. And I'm going to look at what kind of returns you made on that reinvestment with the return on capital. The same return on invested capital you did in a different context now becomes the engine that drives your growth. If you're a company with an 80% reinvestment rate and you can earn a 30% return on capital in your project, guess what rate you're going to grow at? 80% times 30% is 24%. That's incredible. It's incredible because you were able to pull off that trick. If you have an 80% reinvestment rate and you have only a 10% return on capital, your growth rate is going to be only 8%. Would you like to grow at 34%? Absolutely. But pigs can't fly. I'm not suggesting you're a pig because you make a 10% return on capital. But if you do make a 10% return on capital, you can't grow at 34% unless you do magic. So think about those two numbers because they're going to drive the growth rate. In the next session when we start, we're going to complete the process of valuation by bringing in the rest of the growth story and the terminal value. Yes?
For return on equity and return on capital, why are the numerators different? So why return on equity is net income because EBIT after tax?
If you're an equity investor, net income is what you get as earnings. Looking at the firm, it's the operating income that both equity and, remember we talked about the firms, equity investors and lenders. Operating income is what services both groups.
Talk about changing beta for the future one. Will it be okay to change also risk-free if you have the expectations of higher interest rates?
You have to be careful though, because then your valuation becomes a joint. When it's not just that, because then your valuation of a company is reflecting two things. Your expectation of interest rates, and that's a very dangerous place to be because then if you tell me to not buy a stock, I'm not sure whether you're asking me not to buy the stock because you don't like the company or because you think interest rates are. So it's always good to keep your macro assumptions separate from your micro assumptions, which means even if you have a strong view on interest rates, tell it to me separately because that's an asset allocation decision. And then do your valuation as if today's interest rates will be the interest rates in the future because then I can see what's driving the company's value and what I should be doing with the asset allocation. Hey.
Just a couple of questions I had.
Yep.
Firstly, so the return on equity and retention ratio, if you use that as a growth rate, I mean, empirically, does it work? Has it been a good
Only for say, you got to settle down. Once your margin settle down, it works, but not before your margin settle down. Until your margin settle down, it will not work. So if you pick a mature company, the company that reads that, that's what it is.
Okay, good. And second, as a discount rate, say I know a company, I understand it well, I want to earn 10% of it regardless of WACC and everything. Is it completely unreasonable to just use 10%? Or would you?
Yeah, you can't make up. You're a price taker when it comes to cost of equity. You can't just make up a number, right? The number has to reflect your opportunity cost, what you can make elsewhere in investment of equivalent risk.
Yeah.
So unless you can show me that 10% is what you can make on another investment of equivalent risk, it's not a discount rate.
Yeah,
It's a return you'd like to make, but that's neither here nor there.
Yeah, sure. Okay.
Yeah.
All right, great. Thank you.
Hi.
Quick question. When analyzing good projects versus bad projects that my company is making,
All you can do is make a collective judgment about all its projects, right?
so just taking a look, I mean, because there's no way that I'll know the profitability of individual projects.
But you can tell me the profitability of a portfolio of projects.
Right. But it won't tell me, I mean, the portfolio of projects being the entire company.
Yeah, that's what a company is, right? It's a collection of projects. When you do a return on capital for a company, what are you getting? You're getting a return on capital across the portfolio of projects.
Right.
So if your portfolio of projects delivers less than the cost of capital, the fact that you have individual projects that beat is not good enough, right?
Right. So analyzing the difference between return on capital.
That's what you're doing. You're looking at the portfolio of projects, and then collectively your projects are not delivering the cost of capital. And maybe there's a really good explanation in this particular company. Maybe it's Netflix, and they're a young growth company, and the existing projects are not quite ripe enough to harvest. No, but that's why you started the portfolio project, because that's all you can observe from the outside.
Okay.
Hi.
Two questions. I'm doing DreamWorks and acquisition aside.
Yeah.
They
It's not going to happen before May anyway, so you'll be fine.
yeah, their share price spiked, but anyway. They have a joint venture in China, which I know is a big part of their business.
Right. Yeah.
But they are one of those companies that just lists the U.S. and then the rest of the world for their revenues, and I'm having a hard time finding
So China is
a
in the rest of the
reasonable
world?
way to, because they get revenues, box office revenues from everywhere, from all over, that I don't feel like splitting it between China and the U.S.
So just do the rest of the world. Just take the rest of the world equity.
Just do all of them equally.
No, it's not equally. Just take the rest of the world. It'll be a GDP weighted average.
Of
So basically, take that Excel spreadsheet I have, set the GDP to the U.S. for 0, and take an average of the rest of the countries.
okay.
That'll give you a GDP weighted average. So clearly, China would still be a big part of it because it's the second largest economy in the world. You know, so it will take into account the bigger markets over the smaller markets and build that into your equity risk.
And then they have lease obligations, but they just, in this year's 10K, started to sublease one of their locations.
And
it's
they're getting a
listed in
lease
the same
income.
table.
So
I'm
they're getting a
tempted to
lease income from
lease
that?
income from
Yeah, lease incomes
subleasing.
don't matter, right? So in a sense, they're a revenue source. So
I was tempted to net it out of
you
their
can net
lease
it out. Yeah,
obligations.
that's fine. You can net it
Okay.
out.
Okay, thank you.
Okay.
Hey,
Hey, how are you?
good. I have a question still, sorry.
Yep.
I know the operating leases and I get it, but now I'm dealing with the commitments, which are off balance sheet. My company is Netflix.
Okay.
Like the broadcasting, all of those.
So your operating income.